Well, yes, he does. In fact, President Trump has seen more than his share of controversies and chaos during his administration. One area, though, where he has been scandal-free has been the economy, which has boomed under his watch. In fact, Trump has put a unique stamp on this economy in ways that the country probably has not seen since at least Ronald Reagan. And now even his critics are conceding that the booms we've seen in GDP, employment, and investment are due to Trump's policies alone. Moody's economist Mark Zandi was one of the president's early detractors during the campaign. He actually predicted a lengthy recession under a Trump presidency. Now, he tells CNBC that his predictions are 0.7 of a point higher for both 2018 and 2019 than they normally would be, and that's thanks to Trump's policies. Along with that, we've had increases in business investment and near record levels of consumer and business confidence. Those are also courtesy of the Trump economy. Now, the big question is, how long will it last? Well, while predicting big gains over the next 2 years, Zandi thinks a recession is still on the horizon, perhaps in 2020. Other risks for the economy: an intensifying trade war with China, rising interest rates, and also the swelling debt and deficit issue that could be made worse, again, thanks to Trump. For now, though, the economy's booming, and the president at least has that to brag about amid all the other issues that have been dogging his administration. Guys?
Jeff, stick with us. Let's continue the discussion, and we'll bring in Chris Thornberg from Beacon Economics. Chris, I guess we could go into the question of how long it will last, but yeah, is it fair to say that regardless of how long it lasts, that the economy is stronger on most measures than anyone predicted before the election?
No, I wouldn't say so. In fact, I think the underlying trends in the economy today are very similar to what we saw back in 2014 and 2013. In fact, if anything, the pace of job growth is a little slower now than it was then. Of course, mind you, that's driven by labor scarcity. But really, these numbers we're seeing today are exactly what I would expect, given the expansion we've been in for almost a decade now. The only real change that's occurred over the last 18 months of any significance, of course, is that tax plan that went into place last year. It's traditional fiscal stimulus. They increase spending and cut taxes. Obviously, that's going to give us about a half-point boost. But remember, that half-point boost comes from borrowing from the future. We are, of course, fueling this little bit of a surge on the basis of borrowing money at the federal level, and someday we're supposed to be paying that back.
What about deregulation, Chris? I mean, that's been a big story if you talk to companies across industries as to why we're seeing some momentum and high confidence levels.
No, not really. Look, I know some deregulation has taken place, but to be honest with you, to try to tease out the impact of small amounts of deregulation here and there relative to the, say, overall size of the economy, it's very hard to see those effects, and they tend to be minute at best. Remember, the big number we got in the second quarter of this particular year, that 4.2%, was largely driven by an acceleration in consumer spending, not by business spending. And of course, that acceleration in consumer spending goes back to the relatively weak first quarter we saw. Again, to me, this is same old, same old. It's a good, solid economy, no doubt about it, but I don't see anything significantly different than, say, 5-6 years ago.
Jeff, what's your overall conclusion in terms of whether the president does deserve credit and if it's likely to continue?
I think
listen, yeah, I would argue that in general, presidents don't have nearly the power anybody.
Chris, my apologies. That was for Jeff. Jeff, go ahead.
Sorry, my apologies.
I think when you look at the duration of the economy, what you have to look at is the history of what we've seen during the recovery. We've seen a very tepid recovery. We've seen low levels of confidence. We've seen low levels of business investment. And most importantly, we have huge levels of liquidity that have been sitting on the sidelines waiting to get put to work. You cannot discount the importance of those consumer and business surveys. You have basically over $9 trillion in plain vanilla savings accounts. You've got probably well north of $4 trillion in cash on balance sheet, right, for corporations. You've got $2.7 trillion in still low-yielding money market accounts. There's so much liquidity out there, and there's so much that can get put to work from the sidelines. And I think that it is uniquely that business especially feels that they have somebody on their side in the White House now. They feel like they have more of a known quantity and somebody who will be more amenable to what they need to really start to put cash to work. I think that you cannot underestimate that. And nobody saw this economy coming prior to the election. There were a lot of people who were in the same boat as Zandi who thought that we continue to trudge along 1.5%, 2%. When you talk about 2.5% to 3% in a $20 trillion economy, that's a big boost.